securities basics. And if you have questions, go ahead and stop me. But this is going to be really basic, but some of it is not as basic as you would think. And what I found is more people are not more involved in our securities business simply because they don't understand. They're afraid. They're not sure. Because in America, there's such a lack of financial knowledge that people are petrified of the markets. They're petrified of the markets. Do you realize that half of the public still thinks the stock market is doing bad? You talk to them, they're like, but aren't stocks dangerous? Like, wait a second. It's at an all-time high. It's at an all-time. It's going up 20% a year for 6 years straight. Okay? What do you mean? But that's how uninformed they are. They believe things like you could lose all your money. Okay? And so I'm going to dispel some of these things here tonight by educating you, because knowledge is power, kind of, and the application of knowledge is power. So you having the knowledge is great. You teaching what I'm going to teach you is going to help you build a great securities business, okay? And I'm not known around the company as a great securities producer, okay? But you realize we do over $1 million a month, every month, in new securities business, right? The company pays me about $20,000 a month in income from securities. So I know a little bit about securities, at least enough to teach you, because you don't do $1 million a month, right? Okay. So let's talk about equities. So there's two different sorts of securities and markets that we're dealing in. There are others, okay, but these are the main two. So equities is another word for stock. So when you hold stock, you are an owner. You're an owner. That's what having equity is. Okay, you're an owner. Okay, so let's talk a little bit about equities. A stock is nothing more than a fractional ownership in a company. So if I own a company that I start and I am the sole owner, I have 100% of the equity position. So private companies generally don't have equity positions. They're owned privately. Okay? Some of them create equities and give them to certain key people, but that's rare. So for all practical intents and purposes, we're talking about publicly traded companies. Okay? Publicly traded companies. So there's two sorts of offerings that you guys need to understand. Okay, when a stock gets issued and sold to the public in an initial public offering, okay, or an IPO, who gets the money from the sale of the stock? The company does. So let's say I own a company, and I say, you know what, I want to cash in on this deal, right? So I built it, I'm getting money from it, I own all the shares, but I could sell this to people. And instead of selling it to an individual or another company, I say, well, I'm just going to sell it to the public. So I sell 1 million shares at $1 a piece out in the market. What did I get? $1 million. So I got my payoff as the owner of that company. Immediately, what starts happening? You get what's called secondary offerings. So 99.9% of the time, what you're talking about, what you hear about on the news, is not public offerings. It's what? It's secondary trading. So if somebody buys a share of AT&T today, what does AT&T get? Nothing. They already got what they got 100 years ago when they went public. So now the shares are just being traded back and forth from investors. The company that offered it has nothing to do with it any longer. You understand that? So there are primary offerings and secondary offerings. Okay? Where is the money going? On primary, the money's going to the company that's selling the shares. Why is a company going to sell you shares? There's all sorts of reasons. Maybe I want to cash out. Maybe I want to take my money off the table and go home, right? Maybe the company needs a lot of capital to grow. So instead of just doing it off sales, they can sell their stock. So they give up part of the company to the public and get a bunch of capital in, right? And then use that capital for whatever they want. Why do people buy and sell stocks in the secondary market? To make money, okay? So, what is the value of a stock? The value of a stock is based on the valuation of the company, but not really, because the company valuation is based on the price of the stock. Okay? So if you had 1 million shares in your company and they were selling for $1 a piece, how much is your company worth? $1 $1 million. If the share price went to $2 a piece, how much is your company worth? $2 million, right? So what sets the price of a stock? Well, one would think it's the value of the company, but that's not really true. The market sets the value of a stock, and we're going to get to this in a little while here about why do stocks go up and down. And we'll get to that in a minute, okay? But you have to understand, right? Stocks are valued based on people's perception, okay? It's generally called a P/E ratio. You want to sound like you know what you're talking about? Ask somebody about a P/E ratio. What is a P/E ratio? Price to earnings. So a company makes money. Let's say a company makes $1 million this year. That's what the company makes. There's 1 million shares. How much per share did they make? $1 a piece. So every shareholder earned $1. Okay? So that's their earnings. Okay? But most companies are not valued at what they earned in a year. They're valued at some multiple of that. Why? Because if I could buy a share for $1 and it made me $1, next year I'm scot-free. I already made my investment back and I'm earning 100% investment year after year. Does this make sense? So what happens is a company's making $1 million a year, they can sell their shares for a lot more than $1 million. Depending on the industry, 10 times, 15 times, 20 times, sometimes outlandish, like 30, 40, 50 times what they're earning. So a price to earnings ratio, right, basically says, let's say the share is $10 a share. The company has 1 million shares that made $1 million. So the earnings per share were what? $1. $1. The price of the share was what? $10. So what's the P/E ratio? 10. It's 10 to 1. So what does that mean? If you buy that share, it should take you 10 years of earnings in the company to pay back your share. Does everybody understand that? Okay. What affects the stock price? Two things. Okay, two things. Number one is earnings or potential earnings changes. So if a stock traditionally trades at 10 PE and the earnings start going up, what happens to the price of the share?
Goes up.
Goes up. Why? Because the investor says, well, it's 10 to 1, but they doubled their earnings last year. So if it stays 10 to 1, the price of the share should double. You understand? Okay, so as a company does better and makes more money, that drives the price of the share up because there's a fixed amount of shares, right? There's a fixed amount of shares, but the shares are earning more per share. So the price goes up, okay? Believe it or not, that does not move the stock price hardly at all compared to market activity. So one of the greatest things that you could ever learn about the stock market in general, why does the stock market go down? Because people are selling. Why does the stock market go up?
People are buying.
Because people are buying. This is largely the only reason the stock market in general moves. Okay? Because people are selling. So if you sell 1,000 shares of something and nobody wants to buy it, you got to keep, if you have to get out, you got to keep lowering your share price till somebody bites. So the only reason the markets go down is what?
People are selling.
People are selling. Why are they selling generally? Because they're afraid. Because other people are selling. The stock market is largely driven by people's perceptions and emotions, not by math and logic. Okay, here's why. Let's explain. In 2008, the market went down, the Dow went down 48% in 1 year. So you had an AT&T share. So you had a part of AT&T's company. You're an owner. You have that fractional share of every contract they have, every office building they have, every satellite, every tower, every piece of cable around the world. So the share price went down by half. Okay, but did AT&T lose half its customers?
No.
Did half its buildings go into foreclosure?
No.
Did they dig up half of the cable laid all around the world?
No.
So the exact same company with the exact same assets and virtually the same earnings, the price of the share went in half. But none of its fundamentals went in half. So what happens is all the idiots sell because they're afraid, and sooner or later it gets low enough where smart, wealthy people say, this is outrageous. I'm buying this company at 50 cents on the dollar, but everything they had last year they still have. So what happens is the rich start pouring money back in. They start buying. So you're selling me your AT&T at half of what you bought it for. So I'm like, I'm in. Well, now I buy him out of his AT&T, and there's no more AT&T. So now when Ryan wants to sell his AT&T, what happens? He gets a little higher price. But I'm back in the buying mode, right? I'm like, man, not only this hit a bottom, it's starting to creep back up. I'm going to get as much as I can. So now money starts coming in from everywhere, and now there's no shares to buy. So what happens? So the people holding them start creeping their prices up. When the price goes up, did AT&T get double the amount of customers they had?
Nope.
Did they get twice the amount of buildings?
Nope.
Did they get twice the amount of cable and satellites? No. It's the same company. It's the same company, you all. Right? The only difference was how people felt about whether or not they wanted to own it. Is it possible for the stock market to go to zero? No, it is not. Why is it not? Because you own shares in real assets. Do you understand that? You have people say, well, stock's just paper. It's a paper certificate of your ownership stake in a real entity. So unless that real entity goes away, you will always own something of value. Does this make sense? Okay, so what if I lose all my money? That is the statement of somebody who is extremely ignorant of the financial markets. Extremely ignorant. It's not possible for you to lose all of your money in the market. Now, what if you bought a stock in a company that went bankrupt? You could lose a lot of your money. That's why you don't buy individual stocks, and we're going to get to that in a second. But in the market in general, okay, it's not possible that every company on the planet would go bankrupt. People say, well, what happens when the dollar goes away? Which maybe it will at some point. Who knows, right? If we just keep printing currency, we might get replaced as a world standard, okay? So what happens when the dollar goes away? Total chaos for about 3 months, okay, in which you should buy everything you can, okay? And then what happens? Whatever currency comes in, a share of AT&T, whose company is worth this, is worth 2 shares of this company, whose company is worth half of AT&T, and whatever you have, pesos, yen, Leonard dollars, whatever that comes out, okay, it's all going to be relative still. You understand that? It's all going to be relative. A share of AT&T, based on their current book value, is worth X loaves of bread. And if the dollars went away tomorrow, you could still trade X loaves of bread for that thing. Now, how would they pay their contracts? Well, they'd pay it in whatever new monetary system. It would be crazy for a couple of months, but then we'd settle on whatever currency was being used, and whatever you owned would still have value relative to everything else that still has value. Does anybody have questions on this? Okay? So it's not possible for you to lose all your money in the market, simply because you own actual things. Sooner or later, somebody will buy them from you, right? What happens to profit? Profit's one of these dirty words in our country today. Oh, these evil profits. They're skyrocketing profits. Okay? Here's how you know these people are trying to pull a fast one over you. When they talk about big profits, oil company, record profits. Okay? The news media and the people who are against free market profit want you to believe that CEOs of companies and other people are the people who are getting the profit. That simply is not true. When a company makes a profit, okay, so it's revenue in minus expenses, that CEO's salary is a what, by the way?
Expense.
It comes out before profit, dum-dum. But why are you so fired up about profits when the CEO's salary had nothing to do with profit? It was an expense. It took away from the profit of the company that you're so upset made so much money. Okay? So if there are no owners, individual owners of the company, because the shares are publicly traded, so there's hundreds of thousands, potentially millions of owners, and the company has profit left over, who gets it?
Shareholders.
Kind of.
Shareholders.
No, not all the time.
Taxes.
No, profit's after tax. Net profit is after tax. What happens to the money, y'all? AT&T has $500 million sitting there this quarter. They cutting the CEO a check for the $500 million? That's what the media wants you to think. It's evil rich people. Okay? Who's getting the money? The answer is AT&T keeps that money and reinvests in more infrastructure, buying other companies to make even more what next year? Profit. So they're taking the money and they're saying, hey, I made this with 1,000 offices. I'm going to open 2,000 offices this year. So next year, instead of making $500 million profit, I'm going to make $1 billion profit. So the company reinvests in its own business or in other businesses to make even more money, and any money they can't use gets given away as a what? A dividend. A dividend is a distribution of cash. The company said, all right, we took all this profit, we bought all these other assets to make even more profit for you next year, shareholder, and we don't know what to do with this pile of money, so we're just giving it out to you as a dividend. So who got the profit? The answer is the shareholder got it in two forms. Even more profit next year and cash coming in off the share. Everybody understand that? So why are we upset about these companies making profit? We're the ones getting the profit, right? It's crazy to me how people don't like profit, but the reason you have a 401k is because of profit. The reason you have a chance at retiring in America is because of the profit of corporations. By the way, the corporations aren't stealing the money. People are giving it to them for their product and service, right? Why are we upset about profit? Everybody should want everybody to make as much profit as possible, right? Okay, so everybody understand what happens to profit. Why profit is good, profit is not bad. There is no single person benefiting off of the profit of big, giant companies.
If a company has profit, it's just showing their standing, like they're in good standing, making money.
Well, they're correct. They're returning for their investors. So those are equities. Everybody have an understanding now of equities. You're an owner, a fractional owner, the company's making money, and they're reinvesting on your behalf to make you even more money, and any money they can't reinvest because they don't know what to buy, they give back to you. Okay? It can't go down because you own shares in real companies and real things that have real estate and real client bases and real accounts receivable and real infrastructure. Okay? Any other questions on that? Going once, going twice. Okay, the second market you're going to work in a lot is the debt market. Debt. What does that mean? This is also called the bond market. Bonds are debt. Stocks are equity. There is a difference. If you're an equity owner, you're an owner in the company. If you're a debt holder, you've made a loan to a company or a government, but you don't own anything. You're the bank. Okay, you understand that? So equity, you have positions in all the future earnings. Debt, you're just being paid back. And when you're paid back, you're done. No ownership. Borrow, you're a lender. Does this make sense? Okay. So, same way with equities, debts work in a primary offering and a secondary offering. So if a company does a bond offering to the public for the first time, who's getting the money from that offering? The company is getting the money. Now, why would the company want to issue bonds instead of give stock away?
They don't want to give up ownership of the company.
Right. If we think this is going to work real well, why do I want to cut your butt in on it? Just give me some money, I'll pay you interest, and I'll keep all the profit. Right? If I think this is going to go well, I'd rather issue you bonds all day long than cut you in as an owner. Does everybody understand that? Yeah. Okay? So the primary offering, the company receives the money. Now, virtually immediately, what starts happening? Y'all start trading it. Now, I want that. I want that. Right? And so who's getting the money in secondary markets? Whoever you bought it from. Not the company or the government. They already got their piece. So private companies issue debt because they don't want to give up ownership. Okay? Public entities issue debt because they're horrible at managing money and they're not actually doing anything in the economy. So the only way they have to get money really is to try to issue debt. Okay? So let's say, how many of you pay a water bill every month? You're on city water. Okay. So your city knows you're going to use water every month. Say it's $50 a month. Your value to the city is how much this year? $600. Over 10 years, $6,000. So the city, being broke and doing nothing but sucking from individual people, okay, it says, I want $6,000, I don't want $50 a month. So what the city says is, I'm going to sell you, Sherman, a $6,000 water bond, and I'll pay you 3% interest, right? And what the city's doing is they're getting all Steve's future value today, and then they're paying you back interest payments for 10 years. So what's happening is, you gave me $6,000, I'm the city, okay, I'm paying you 5%, right? Okay, so what is that? 30 bucks a month? A year. So I'm paying you 30 bucks a year. But he's paying me 50 bucks a month. So I'm double dipping here. Right? So I'm double dipping now. I'm the city. I got $6,000. I have to pay 30 bucks a year to service it. He paid me 50 bucks. It's the same thing. Right? But if I default, I'm securing you with him. But I'm not going to default. I'm just going to refinance that debt 5 years from now or 10 years from now. So what the city's doing is saying, look at all these people paying their bills. These are worth this much over the next 10 years. And then they go and they raise all the capital today. They pay interest from the payments the people they're securing it make to them. And then they use that money for other crap. Right? And then they refinance again. Until they run this gigantic mountain of debt up like the city of Detroit they can't pay, and then they file bankruptcy. Right? That's generally what happens. So entities, governments have credit ratings. Right? So city of Detroit ain't so pretty. Right? Okay? But like Oakland County's bond rating is what?
A+.
It's AAA. It's good. Why? Because they're actually paying back the bondholders. Their credit is good. Their borrowing debt to income ratio is not bad. So they're going to pay you back, right? Okay, does everybody understand what a bond is? So you buy a bond for the interest rate. So in that same example, I sell Sherman a $6,000 bond. He gives me $6,000 a day. I'm paying him interest. At the end of 10 years, my bond promise is what? You're getting the $6,000 back. So I'm servicing like an interest-only loan, right? And at the end of the 10 years, hopefully I've collected the money as the city. I've invested it. I've earned interest on that more than I'm paying him, and then I can pay him back. But I had usage of the money for 10 years instead of 50 bucks a month for 10 years.
Yeah, but he got a guaranteed $6,000 coming plus interest over 10 years.
Correct.
As an investor.
As an investor. Yeah, as an investor, versus the market goes up, the market goes down. He's got a guarantee from the city or the company he did the bond with that in 10 years or however long the bond is, he's getting all his money back plus a guaranteed interest rate. Guaranteed by who? Whoever you bought it from, but it is guaranteed. Everybody understand? Okay? So generally, you have much lower upside potential in the bond market because there's a guarantee. You have much higher upside potential in the equity market because if the company starts compounding on itself, this thing just goes crazy. Right? Okay? Everybody understand? Questions on bonds?
What if the company or the city goes bankrupt? What happens with their bond?
They got to pay you.
That, well, no. Well, that.
You're first.
You're one of the first people. So what happens? Unpaid salaries.
Taxes.
Right? Taxes. Then bondholders. Then shareholders.
So you're a senior. You're in a senior position. You get your money.
Well,
What percentage? do you
compared, yeah, the third of 4 senior positions.
have? Unless it's general.
Yeah. So anyways, what happens? They go through bankruptcy. A judge says, what assets do you have? Right? And then you've got to sell them. And then whatever's left there, the assets pays eventually back to bondholders. Okay? So now, generally, municipal bonds are privately insured. So there are insurance companies that insure the against default. So if this city goes bust, you don't need to worry. We're going to step in and pay an insurance claim to make the investors whole. Does not happen on corporate sides. Okay, does everybody understand this? What affects bond prices? Interest rates. So let's say I'm paying Sherman 3%, but interest rates rise. The Fed starts moving the interest rates up. So now everybody and their grandma's getting 5% at the bank with no risk. But I'm getting 3%, I've got some risk that he's going to default. So my bond price goes which way? Temporarily. Because remember, let's say it was a $10,000 bond, well, the price can't go down forever because when it matures, I get what? 10 grand. So it can dip temporarily because I don't want 3%, I want 5%. So I'm willing to sell a little bit below what the bond is worth to get my money to put it somewhere else. I'm willing to take a small hit. So if I'm selling a little lower to get out and you're selling a little lower to get out, what happens to the price of the bond?
Goes down.
Goes down. But eventually it stabilizes. Now what happens if Sherman's a company, he's B rated. He sells me a bond for 7% for 10 years. Sherman's company does a lot better. Their balance sheets get better, things are going good. All of a sudden they're A+ rated. But he's still paying me 7%. What happens to the price of that bond?
Goes up.
Goes up. Because now he's like, dude, I'll pay you 11 grand for that bond because this thing should be paying 2%, but it's paying 7. I'll pay you a premium on the bond to get that interest rate because that's a super good interest rate for the risk I'm taking. You understand that? But the closer the bond gets to maturing, eventually it comes back down to what it's worth. Why? Because when the bond matures, I just get whatever the face value of the bond was. So you buy bonds for what? Interest rate or yields coming off the bonds. Income. It's like you own a mortgage. Instead of you paying a mortgage and paying interest, you own the mortgage and somebody's paying you interest. But you don't own anything. You understand? Okay? Markets. Why do bonds go down in price more than just this? Because people get afraid. And so if they all start selling the bonds and nobody wants to buy them, they're forced to sell them at what?
Lower prices.
Lower and lower prices. Right? Okay, so if you're smart and you see bond prices going down quickly, what should you be doing? Buying them suckers, because they're just worth what they're worth. The only reason people sell them is because they lost their mind. Right? Okay, and so eventually wealthy people sitting on the sideline says, here's a real idiot. He's selling me this $10,000 bond for 7 grand and matures next year. What's wrong with this guy? Right? So I'll buy everything you got. So now all of a sudden we run out of 7 grand bonds that are worth 10,000. So then some next guy who's not quite as stupid but still stupid sells it at 8. But then the prices start climbing back up. Everybody understand? Mm-hmm. Can you lose all your money in bonds? The answer is no if you own them in a fund. But if you own them individually and the company you own files bankruptcy, there's potential you could lose money. But generally that doesn't happen. Okay? You understand this? So why do markets go up and down? We already addressed this. Markets go up because people are
Afraid.
buying. They go up because people are buying. They go down because what?
People are selling.
People are selling. Why are they selling? They're afraid. Why are people buying?
They see a good deal.
Because they're
Rich.
well,
They're smart.
they're smart if they're buying at the bottom. Now, if they're buying at the top, it's because they're ignorant. Right? So listen, here's a good rule of thumb. I made $500,000 this year in my investment accounts in 60 days by buying the most beat up, nasty looking thing I could find. It's been losing money for 5 years straight. Everybody hates it. It's horrible. But sooner or later, it gets so low that guys like me start dumping money in this thing. It can't go much lower than that. I don't know, it might go a little lower, but it's gonna go up a ton, right? Okay, so you gotta understand, again, markets are going down because people are selling. And eventually people start buying because it's too good of a deal to pass up, and then it starts driving up. So what happens is everybody's running for the hills when the news media is like the market's crashing, blah, 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 blah. The wealthy and the savvy investors start dumping money in from all the people who just sold low, so they're buying low, right? And what keeps driving the price up now is because they're not selling. So there's more demand because all of a sudden, about 3 years after the downturn actually ends, it's now news media, the markets are doing great. An average Joe investor who's been sitting on the sideline for the last 3 years is thinking, well, I need to get in on this. So now all the dumb money, that's what the market's called, right? All the dumb money starts coming in because they're just all following each other back in. But by the time the dumb money comes back in, all the real profits are gone. Now it's just being inflated by dumb money chasing itself, right? So once it gets big enough that the big money decides I want out, so they start selling because they're saying this thing's way overvalued. Remember PE? This should be trading at 12, but it's at 20 because all the dumb money keeps coming in and driving the price up, so they start getting out. And when they start getting out, what happens?
Going down.
Now it starts going down. But they got their money, baby. I sold out of my position. I got a buy, I had a sell point, I said I'm taking money off the table at this point. I sold. And you know what happened? It went back down, I bought it again. And it's up like another 15%. I just bought another big stake in this fund that I had about a week and a half ago. I put another, just a little under 100 grand in, and it went up 15% in a week and a half.
Wow.
Why? Because people started getting out, like me and everybody else watching this thing saying, dang, I just made like 90% on this mug in 60 days. I'm done. So they sell it all, and right? And then we start looking at it again, well, let's see, the Fed didn't raise rates, so that commodity is going to stabilize. Let's get that again. And then back up, right? Is this a good strategy for you? No. You should be average dollar cost averaging money in over time, but when you get an understanding of the market, you can look for value. When the real estate bubble burst and everybody was losing their homes, Chinese people coming in here from all over the world buying up everything at $5 on $100, and now they rent it back to your bud. And they bought a house for $5 grand, it's worth 50 grand. It wasn't worth 100. It was when everybody who could breathe got a loan. Why did the housing market go up? Dumb money. Dumb money. Anybody qualifies. Nina loans, no income, no assets, no problem. Well, when everybody can get money, then if I have a real asset and I got 10 people who want that because they all got money, what happens to the price?
Goes up.
Why drive it up? Well, you got 100 grand, you got 100 grand, you got 100 grand. Why am I going to sell for 80? There's a limited supply. Everybody's got money. That's why you got to watch out for raising the wages. Because if you artificially give more people money they didn't get, then what happens to the prices of everything?
Goes up.
There's a certain amount of crap, y'all, that people actually made. But if everybody's got more money, right? You ever watch Survivor where they have the challenge where they all get $500, they bid on items? People paying $500 for a bowl of food. Why? Because they all got $500, but there's only so many bowls of food. So that bowl of food worth $5, somebody paid $500 for. Why? It didn't matter. They had the money, they didn't have the thing. So if you give everybody more money, but there's the same amount of things, what happens to the price of the thing? Goes up. So the people who were earning X are the ones who get hurt because they were earning to get this. These people were just given this. So this person's buying power got eroded because everybody had more. Giving people wages they didn't earn does not make them better off. It makes everybody else worse off. Folks, this is just common sense 101. If everybody's got more money but the same amount of crap to buy, then the person selling it can charge you more. because everybody's got the money to buy it.
Right.
And
You get this?
the companies aren't gonna give up their profit, they're just gonna raise prices on everything.
Well, it has nothing, but it has really nothing to do with the profit. It has to do with supply and demand. These things are selling for faster than we can make them because everybody's got the money to buy it.
So let's raise the price.
So let's raise the price. Because I either need to make more or I need to make more per unit. I get one of the two, so it's easier for me to make more per unit than make more
units.
Because if I gotta make more units, I gotta pay this guy more because they're making me.
Exactly.
So I'm just gonna raise the price. I'm gonna make the same amount of units, but I'm gonna charge you more because you have the capacity to pay more. Isn't that something?
It's capitalism, man. It is
Woo!
finance. You gotta love
No,
it.
no, that's ain't capitalism.
No.
That's government intervention in capitalism.
Yeah,
Real
yeah.
capitalism, listen, real capitalism says this. Let the markets decide. If we all work for an agreed upon wage that we set with our employer, and we all have products and commodities we want to buy, and those, see, if nobody has the money to buy your product, what happens to the product? It goes away, or the price goes down. Can't stay the same if nobody has the money to buy it. So if you're artificially pumping money into the system, then you're raising the prices. If you just let the money stabilize, like what happened in the economy when it went down? What happened to gas prices, y'all?
Went down.
What happened to housing prices?
Went down.
What happened to food prices?
Went down.
Because nobody had no money. So that's the economy self-regulating. Well, if nobody has no money and we can't sell the product, we better lower the price and sell the product. But if it costs less to live, then we can pay you a little less. So I can keep making the product and you pay less, but you're also getting less. But it's the same. The product costs $5, you made $10 is the exact same as the product costs $500, you made $1,000. The exact same, folks. This is how it works. But you just feel like you're doing better. Evil rich people, I need to get my share. You're just hurting yourself. Rich people don't care when gas goes to $5. They don't care when McDonald's $5 value meal goes to $10. They don't care. Who cares? Middle class and poor. When you raise wages artificially, the middle class and poor suffer disproportionately. Because everybody's got the money, so the supply goes down, the demand goes up, and the prices of everyday goods skyrocket. Rich people, I don't care. So it costs me $10. Who cares? But you care all day because your buying power is eroding. Okay? So why do markets go up? Because people buy and sell. So what is a mutual fund? A mutual fund is the best way to be involved in the market. Either market, bonds or equities. So a mutual fund is a pool of money, right? So individual investors sending their money to what? A professional money manager who buys what? Lots of stocks and bonds. So the average company, mutual fund, holds more than 150 different stocks. So is it possible to lose all your money in a mutual fund? And the answer is no, it's not. Why? Because they have 150 stocks. The only way they could lose all the money is if all 150 companies went bankrupt in the same 10 seconds before they had the ability to sell their positions in them. Which would never happen. It can't happen. It's not going to happen. They couldn't go bankrupt that fast. Bankruptcy proceedings take time. You can't just say, I'm bankrupt. You file bankruptcy. Okay? And then you go to a court, and the court hears it. It's not possible. Right? So people who are afraid of that are ignorant. They don't know what they're doing. Right? So if 2 of the 150 companies do bad, who cares? You got 148 that didn't do bad. So you're hedging yourself against real permanent risk by holding shares of multiple companies. Everybody understand that? Okay, that's what a mutual fund is. Can a mutual fund lose all its value? We just went through that. What are the 3 ways a mutual fund makes money? Appreciation is number 1. This is the only one your clients know anything about. The Dow was up 100 points today. What was that? Appreciation of the underlying asset. Why did it appreciate? Well, they think it's going to make more money. People are, in general, buying instead of selling. And so the price went from $10 a share to $12 a share. Your share has appreciated. Okay? The second way it makes money is dividends. Okay? So in a mutual fund, they own all this stock. Every quarter, the stocks, if they're paying dividends, are going to pay the dividends. So the guy who's managing the pool of money every quarter has more money than he had before. Because why? Because the shares paid dividends. It gave him cash. What does that manager do with the cash? Buys more stuff. So listen, do you understand if your share is $10 and at the end of the year it's still $10, but it paid a dividend, you made money?
Yes.
But average Joe doesn't understand that. It was $10, it stayed at $10, I didn't make anything. No, that's not true. You made dividends, right? And what? 3 is what?
Capital gains.
Capital gains. So what's a capital gain? So inside of the fund, they bought at 10, the shares at 20, they sell company ABC for 20 bucks, their cost was 10, their capital gain was what? 10. So they get all this cash that they paid 100 million, they got 200 million. Right? So they got 100 million cash back. What do they do with that? Reinvest. They buy more stuff with it. So even though the share price might have stayed the same on all the other ones, okay, they sold a position and made a capital gain and then reinvested and maybe bought more of those other shares. Do you understand that? Okay, so your money's making money 3 ways. So even when the market goes down, what's happening? What's going down? Which of those 3? Appreciation. But the other 2 still working. So even when it's losing value, you're still making money. And if you're smart, you're reinvesting the money in lower price shares. So if your share went to $10, then went down to 5 and went back to 10, but it made dividends and capital gains, you actually have more money, even though your share's the same, because you own more shares that your capital gains and dividends bought you. You understand that? Okay? This is what rich people do, y'all. Rich people make money work for them. Okay? So the rate of return is key. Let's look at this. I love people who don't understand anything about the markets. Okay? Inflation from December 31st, 85 to December 31st of last year was 2.62% over that 30-year period of time. Which means if you had $1 in 1985, you need $2.62 now to buy what you could buy then for $1. Okay? Treasury bills or government notes paid 3.42%. So this is showing 10,000 bucks 30 years later. Okay? Bonds on average paid 6.74%. You put in 10 grand in 1985, you have 70,000 today. But you only needed 21,000 to buy today what you could have bought then. So you did good, right? But look at the equities. The S&P 500 total return, 10.37% on average every year, including 2008, okay? 10.37. Your 10 grand was worth $193,000. But putting money in the market is risky. Okay? Listen, there's risk everywhere. That's called volatility risk. The risk that you're dumb and you're going to take your money out when it's down instead of letting it collect capital gains and dividends and waiting for everybody else to ride that thing back up. Because that's what happened. This is not make-believe. This is what happened. Did you lose money? Well, if you started with 10, you had 100, it went down to 80, and then it went up to 193. Did you lose money? You have volatility risk. Your money went down. The appreciation section of it went down temporarily, but then came back up. Plus, you made capital gains and dividends. You understand? Okay? So you got to get money to work for you. What is the risk of I'm putting money in the bank where it's guaranteed, but I'm earning 1. Well, you're losing. Yeah. So that's guaranteed loss. But average Joe can't tell you how they put in 10 grand, got 11 grand, and they lost. I made $1,000, it was guaranteed. Well, your $1,000 doesn't buy what it would have bought then. You had to make at least 2.6 to just break even. So there's risk everywhere, folks. Volatility risk in the market, the risk that the money might be down from time to time, or maybe down when you need it, right? But there's inflation risk, and that if you're investing in guaranteed assets, you can't ever really outpace the pace of inflation. So you're guaranteed to lose money over time. So this is dollar cost averaging. How we do? Oh, we're going to be out of time here momentarily. No, we'll go through some other stuff, and I'll come back and we'll get this next week. So rule 72, you all know rule 72,
Yep.
right? Okay. This is again just showing you at 3, 6, and 12% interest, right? Take 72 divided by the rate of return, shows how long it takes money to double. Why is that important? We only have so many doubling periods in our life. We have got to put our money in places where we have the mathematical capacity to be where we need to be, right? Okay. So just showing you at 10 grand initial investment in 48 years, at 3% is 40 grand, at 6% is 160, at 12% is 22.5 million. Same investment, same amount of time, where's the money? Right? Where's the money? There are many mutual funds that have earned over 12% a year for 30, 40, 50 years and longer. Okay, remember the S&P is what? Unmanaged. It's just the composite of those 500 companies, right? If you buy a good mutual fund manager, they're going to beat that over time, okay? So some of you have seen this as well, with the high price of waiting, right? If you want to have $1 million at age 67, if you started at 27, this is with a really moderate rate of return, 8%, I believe. Okay, $214 a month at 27 years old, at 8%, which you're going to get more than that over time if you just invest in the S&P. Okay, $214, you're a cash millionaire at 67, right? But if you wait to 47, you got to be saving $1,500 a month. Okay, so every young person you know, you need to be having these conversations with and get them to start saving. How many of you have a PAC mutual fund with Primerica? Raise your hand. Okay, the other half of you, you're missing the boat. Whatever you got to, even if it's $25, start. Because every year you're losing huge money off the end of your retirement. Okay, start. Talk to your RVP and say, set me up a mutual fund. Okay? All right, talk to me. Leonard said let me
He's gonna hook you up.
Okay. So I'll tell you this and then we'll go dollar cost averaging. So this is how I explain dollar cost averaging to a client. Okay? I say, Mr. and Mrs. Client, I want to tell you a story that I promise you you're never going to forget about how investments work, okay? And I want to tell you this because I want you to make the right choices. I don't want you bothering me all the time when markets are up and down, okay? So this is a win-win. I want you to do well. I want you to leave me alone, okay? So here's how this works. Let's pretend instead of mutual funds today, Ryan, I'm telling you and Marissa about an investment in cows. Got a great investment for you, an investment in cows. Okay, and I'm going to draw this upside down. Okay. So I'm going to say month 1, we have $100 a month to invest. Okay, so this is our investment, $100. The cow price is $100 per cow. How many cows do we buy in month 1? One cow. Okay, 1 cow. It's the greatest investment on earth. Beef prices are going to go through the roof. It's going to be incredible. Month 2, there's an E. coli breakout. Your cow price plummets. Okay, it's now $50 a cow. How much money did you lose? Half in 30 days. So you're like, this guy's the worst investment guy on the planet. You're calling Fox to these problem solvers. I mean, you're pissed. But I get you to calm down. I say, don't worry, stick it out. It's going to come back. Let's buy again. So month 2, you put in $100. The cow price is $50. How many cows did you buy? 2. Month 3.
Now you want 3.
Mad cow disease breaks out. Things go from bad to worse. The cow price plummets to a never before seen cow low, $10 a cow. You've lost 90% of your original investment. You're calling your attorney, you're throwing eggs at my house, you're Facebook stalking me and telling me never invest with this guy, he's the worst advisor ever. But I talk you off the ledge. I say, Dave, just trust me, it's going to be okay. The cows will return eventually. Reluctantly, you agree to invest your $100. How many cows did you buy month 3? 10. Month 4 and 5, the cow price at least stabilizes at $10 a cow. You still hate me, but I'm convincing you to buy because I'm a great salesman. This guy could sell, snow to an Eskimo. Okay? So you buy how many cows each month? 10. Month 6, the cow price rebounds to $50 a cow. Still at 50% of what we originally bought in at that first month. Terrible year in cows. How many cows do you buy?
2.
you say, I'm out of here. This is like a roller coaster. This is the worst thing I've ever seen. How much money did you invest?
$600.
$600, $100 a month for 6 months. You sold how many cows?
Bought 10, 20, 30.
You're selling now. You're selling. You're gonna see. I'm out.
You wanna get out.
35.
You want to get out. You sold 35 cows. What's the sale price on the cow right now?
$50.
$50. How much money is that? How much money did you invest? How much money did you get? $1750. What was your profit? $1,150. The cow price never returned to its original price. This is called dollar cost averaging. Systematic investment purchases basically allow you, when markets are high, you're a fixed amount of dollars in, buy fewer high price shares. When share prices are lower, it buys more low price shares for the same amount of dollars. So over time, the only reason this worked is your average price per cow was low, because you were buying regardless of how you felt. So even when it didn't return to where it was better than it was some of the time when you were buying it. So you made money off the movement itself. Do you understand this?
No pun intended.
Okay, so the move.
It was utterly wonderful.
It was utterly wonderful. You guys are. So I explain this to clients because when the market goes down, Dave, when the cow market goes down, what should you be doing? Buying as much as you can. Dave, when the markets go down, the only call you should ever give to me is, here's some more money, can we buy some more? Do you understand why? When it goes down, be thankful and buy more. When it goes up, don't worry about it. We're still buying, but we're minimizing your exposure to high price shares. Do you understand that, Dave? Great. I hope to never talk to you again. And if you never talk to them again and you teach them dollar cost averaging and you put them in a well-balanced portfolio, what's going to happen? They're going to be fine. Why? Because that's how life works. It's how investments work. Hopefully you guys got something out of this tonight. God bless you guys. We'll see you all on Friday.
Thanks.
Hey, turn in your sheets. Turn in your sheets, you uncoachable guys. Turn in your sheets.
It was crazy when I first saw
Do it, especially when I first started out.
Now you're gonna make me do it, aren't you?
It's extra crazy, look at that. And when it started dropping, so I was like, okay. That was awesome.
This phone?
It was awesome.
Should we move this?